But if I pass out from like...
Okay, I'm going to propose that we get started because I looked at the schedule, and if we don't start on time, we either eat into lunch or Chairman Brady's time, and I'm not gutsy enough to do either one of those things. I do want to, I'm very glad to be moderating this panel. I was a little nervous on the last panel that the word dollar was never going to get mentioned, and we'd have to take the entire weight of the exchange rate adjustment on our panel. So I was relieved that we've had a down payment on that. I'm David Wessel. I'm director of the Hutchins Center at the Brookings Institution. I'm very glad to be here. I think all of us who have been journalists or who are in think tanks who like to think about tax policy are enjoying the fact that it's now cool to be thinking about tax policy. And I think we should enjoy it while it lasts, which may say something about my forecast. The panel we have today is Kim Klausing, who's a professor of economics at Reed, Michael Gratz, who's the token lawyer on this panel from the Columbia University Law School, Kevin Hassett, who is at the American Enterprise Institute, and Mick Keene from the Fiscal Affairs Department of the IMF. I want to share two bits of news for you. After all, I have a journalist, and it gives me an excuse to have looked at my phone during the previous sessions. Gary Cohn said today on CNBC that the administration is undecided on creating a border-adjustable business tax. It's one of the options that's on the table, he said. You should not take it from me that that's the option we're going with, but I'm not going to exclude that option. At this point, we are exploring every and all options to get our U.S. corporate tax rate down to the lowest possible level we can get it. So there you have it. For reasons that some of you will know, and if you don't, I'm not going to tell you, Gary Cohn also said that there will be a CEA in this administration. He didn't mention any names, and neither will I. We talked a little bit, this group, about how best to proceed in this, and I wanted to start with one question, and I think I'll start with you, Kim, on this. We've talked quite a bit today about competitiveness, and we've had some discussion about what do we actually mean, what are we competing for. But if we define competitiveness as making the U.S. a good place to locate, expand, and invest, which is to say we're not interested only in getting a share of the revenue, we're actually looking for the economic activity. How do we weigh that objective against the other objectives of the tax code, which are, of course, to collect revenue? And how do we weigh it against other constraints like compliance, simplicity, and fairness? How important is competitiveness in this constellation of objectives of the tax code?
Okay, thank you, and thanks for having me. Thanks to the organizers of this. It's been a great day so far. I think this competitiveness question is a really essential one, and when I think about international tax issues, one thing that seems obvious to me is, at least on the tax perspective, that there's a essential trade-off between enhancing competitiveness and protecting the corporate tax base. For the simple reason that if you ask multinational firms what would make you more competitive, they usually don't say higher tax burdens. And so they're usually arguing for a lower tax burden. And at the same time, we also have revenue needs for the state and an important role for the corporate tax. So in thinking about those two goals, competitiveness and the corporate tax base protection, I would argue that both of them have multiple components. So if you look at competitiveness, for instance, there are a lot of features of the U.S. economy that influence our competitiveness beyond the tax system. So I would mention those as well, how educated the workers are, what the infrastructure is like, what R&D funding is like, whether we allow immigrants into the country. All of these things do affect how competitive and how successful our firms are beyond the tax component. If you look at the tax component, I think you need to look at evidence to sort of figure out, are U.S. multinational firms competitive at present, and how much is the tax system hindering them? And I would argue that our tax system, like many here, is not perfect. It's quite distortionary. There are a lot of ways that we can make it better. I don't think anybody would argue in favor of the status quo, but it's not clear that the competitiveness problem is really the paramount problem. I mean, there's a lot of distortions, but it's not clear that U.S. multinational firms are not competitive for tax reasons. And there's a couple pieces of evidence you could look at. You could look at their effective tax rates compared to multinational firms based in other countries, and the Treasury recently did a a paper on this where it looks like they're pretty similar. You could look at the burden on foreign income, and it's true we have a sort of a stupid territorial system where you have to leave the income abroad to get the low rate, but the burden on foreign income is in some respects lower than it would be if we adopted a tough territorial system, if you just look at effective tax rates. Or you could look at the data on multinational firms. Their after-tax profits seem to be higher over the last 10 years by about 50% than they were over the previous 20 as a share of GDP. So it looks like our firms are pretty profitable in after-tax sense. They have a reputation of being leaders in tax avoidance. So they're competitive in that sense. And if you look at the Forbes list of the top 2,000 firms, we have more of those than we have of world GDP, no matter how you measure that. So I would argue that we're pretty competitive. That doesn't mean our tax system is good. There's a lot of bad things about it, but it's not, I wouldn't say that that's our foremost problem. If you look at the tax base erosion problem, I do think we have a very large tax base erosion problem. I estimate that that costs us about $100 billion a year. Some people say, well, the corporate tax is a bad tax, so if you erode something that's bad, less of a bad thing is a good thing. And I would be a little cautious about making that argument because I think the corporate tax has a really important role to play in the larger tax system. For one thing, we don't tax a lot of capital income at the individual level. Steve Rosenthal and Len Berman and I and others have shown that really only about a quarter of U.S. equity income is taxed at the individual level. So we're really relying on the corporate tax to do that work for us. And if we don't have a good capital tax, I think that creates issues for equity, for efficiency, for tax administration, and for revenue. And I think all of those are really important things to keep in mind. From an equity perspective, for instance, capital income is much more concentrated than labor income. And so giving up on taxing that by allowing the corporate tax base to erode, I think, is a problem. From an efficiency perspective, I also think it's important to note that a lot of the corporate profits these days are likely to be rents rather than the normal return to capital. So Treasury has done a study recently that suggested that the neighborhood of 2/3 or perhaps even more of the corporate tax base is really excess profits, not normal profits, which pertains to some of these proposals.
So if we went to I think we should call it the hour back tax rather than, no? Now, one thing I was really pleased is I was at a Peterson Institute conference on tax, and some people who seem otherwise intelligent were distinguishing between the VAT, a value-added tax, and the BAT, a border adjustable tax, which when used many times in the same paragraph left everybody confused, including in some cases the people who were using the but if I went to a destination-based cash flow tax, are you just saying, well, you're okay with that? It's a good idea, maybe helps us with the base, and you just want to have an argument about where we set the rate?
I think there's nothing wrong with that tax that couldn't be fixed by three things. One, a higher rate, because once you've made the base immobile and once you've exempted the normal return to capital, there's no argument for the 20% rate. And there's no reason not to match the top labor rate. And Alan Viard and I were both at something yesterday where we agreed on this, that really that the rate should be higher. Two, I think you need time to solve all these implementation problems. I don't think this is a first 100-day proposal at all.
I assure you, no danger of
that. That's an issue. And and third,
got lots to worry about, but that's not one of the things.
Yeah, and the third thing that I would worry about is the cost of the world trading system. I do think we need to be delicate in how we deal with this and how we deal with our trading partners. And if we were in a different administrative policy climate, I would be less concerned about this, but I would really worry about the future of globalization, and I think we're in a really delicate time. And so I hate to see the U.S. just sort of trying aggressive unilateralism on every front, including tax policy. So I would like to bring some of the trading partners along in that. But I think aside from those three issues, it's a good idea.
Okay, Kevin, how much do you think we should worry about the competitiveness of U.S. companies? And how much can changing the business tax system do to increase that competitiveness?
Yeah, thanks. That everybody in the room knows that I'm a huge fan of Paul Krugman's, but he really did write the paper on competitiveness that we all have to look back to because it's a very dangerous concept that gets abused all the time. And Glenn Hubbard and I wrote a book a few years ago, edited a book called Rethinking Competitiveness. And we sort of took some of the lessons and boiled them down to an argument for why the Brexit would be a good thing for the UK, and wrote an article in Foreign Affairs this year that if you want to dig more into what I'm about to say, which you probably don't, but if you did, then you could go read the Foreign Affairs piece. But I think that if competitiveness is going to have a useful or have some use in the international policy sphere, then we have to try to think about, well, what do we mean by competing? Who's competing? Is it zero sum? Is it not zero sum? And where Glenn and I wandered after thinking about this for a good long time was that if you start with the presumption that the world has gotten really, really flat, that the distance between like having a job in London and having a job in New York is a lot smaller than probably having a job in Boston and having a job in Hartford was, back in the day. And so that increasingly the arguments in the local public goods literature that TIBO competition drives efficient government provision because people move to the towns that are run well is something that we should think about being a relevant force in the international community. And Glenn and I think that that TIBO competition, properly defined and understood, could be a force that would be a very populist force for big international organizations like the EU, because if what the EU does is it enhances the competition between the governments, then the governments in the EU will be sort of constrained at how inefficient they could be. They'd have to be responsive to their citizens, otherwise their citizens will move. But there's a danger too that a big organization like the EU or other bodies that we might join could be like a cartel, that they pick like some bad policies and then enforce them, and so therefore the competition doesn't serve the citizens. And so as I'm thinking about like which organizations that I think the United States should belong to or how the world should work, then I think that if we're doing something that enhances TIBO competition, then it's it's.
Can you define TIBO competition for the journalists and lawyers in the room?
Yeah. So the basic idea is that, think about it. So the original thought was Samuelson, I think, was at the University of Michigan giving a seminar about how private goods are efficiently produced by the market, but public goods aren't. And then TIBO, who I think was a graduate student at Michigan at the time. They used to have some really great professors at Michigan, Jim. They taught some great guys. He just said, well, what if people can move? He said, if people can move, then the towns have to compete for the citizens, and that competition will make the government sufficient. And so, clearly the EU, if you look at what they do, that they haven't thought of their mission as being like the populist one, which is protecting the citizens of Europe against the growth of big government by increasing competition between governments. They've harmonized, banana standards, whether diabetics can drive, and all sorts of things that, probably should happen at a lower level. And so the last thing I want to say is that going back to really early research that Alan and I did when Roseanne and Alan and I were still at Penn, that we've often thought a lot about how people who are optimizers or like firms, they think a lot about what the tax rate's going to be in the future. Roseanne's dissertation was about tax loss carry forwards and the dynamic effects of carrying them forward, and whether the tax rates change means that your tax loss carry forwards might be worth more or less or something like that. But I think that as policy analysts that we need to start to think that the government needs to be forward-looking too. And if nations are engaged in a competition, we need to think about, well, what's the equilibrium of this competition? And we could try to enforce this really inefficient source-based corporate income tax, but the gains to defection are so high that everybody else around the world has been cutting them. And then ask yourself, look ahead to what is the equilibrium? And I think the equilibrium is something like the hour-back tax. And I do kind of think that in the debate, we should ask ourselves, what's the long-run equilibrium of the game that we see? Are we going to be able to construct a cartel that keeps us from getting there? If not, then the reform that we adopt should probably move us towards that equilibrium.
Mike, Mick, we talked, as I mentioned, the dollar came up earlier. What do we know about how the dollar is likely to react if the U.S. was to enact a destination-based cash flow tax, given what we know about how the dollar has reacted to changes in VATs in other countries, even though they're all smaller than Rhode Island?
Well, again, thanks for the invitation to be here today. It's really great day. Really, there's actually very little empirical evidence that I know of that one can draw on this. in fact, I was thinking now the topic came up again. I was looking back at some work that we have done on effects of VAT changes, but then I realized that we had carefully chosen the sample to have fixed exchange rates, so we didn't have to get into this issue. But maybe just to mention one line of work we did on that, because I think it's a little relevant to the debate, and comparing what's going on in the maybe the discussions in the US with what's gone on elsewhere, is of course a few years ago. One standard piece of advice for troubled countries in the Eurozone was to go through a fiscal devaluation. And what that meant was to increase the VAT and cut payroll taxes on labor, which is precisely the kind of the logic of the destination-based cash flow tax. And the idea was to have a boost, at least a short-term boost to activity. And there we did actually find that there was quite a significant impact from that. So, which is always nice for tax people. I think it's always nice when you have at least some effect in the data. So there clearly was an effect there. The question then as well is, what is our model for how these kind of effects, when they come up in domestic prices, when they come up in exchange rates? I think a lot of economists' intuition is to say, well, which price adjusts quicker? And to think, well, probably exchange rates are going to be adjusting quicker than other things. But there are certainly sort of macro models working on this to try and figure out really a little bit more the kind of the price dynamics, how it works out, which of course affects not only the short run adjustment, but it also affects the long run incidence of the tax, how far the adjustment is through internal prices and how far it's through the exchange rate. It matters quite a lot for what we think of the distribution impact, even if in some sense to the first order that the real equilibrium is the same. So I think that's what one learns about the exchange rate issue, which is not much. But maybe just to mention, I think a couple of other things wanted to mention that one can draw from the VAT experience, if I could. One is we've both Alan and Itai pointed out the kind of the economic equivalence between a destination-based cash flow tax and a VAT with a payroll subsidy at the same rate. Of course, the VAT that's equivalent to a single rate destination-based cash flow tax. No country in the world has a VAT of that kind because, as you know, typical VATs are not single rate. They have all kind of exemptions, which is important, I think, when you think about, well, might we go down this alternative? Maybe we should go down this alternative route of the VAT, just to bear in mind that actually succeeding to pass a kind of a single rate clean VAT that would kind of mimic the effects of the DBCFT is not politically going to be terribly easy at all. And does raise a lot of the same issues with how you treat financial services and so on. I also just very quickly on Kim's point about not rushing in, just to mention that the fund standard advice for a country that's introducing a VAT is that this takes about 2.5 years. So I'm sure the US could do it quicker, but it's not a trivial point.
So, Michael, if you were making a list of questions about the DBCFT that haven't been raised yet today.
There it is.
Yeah, I know. But half of those, I read that already. So half of those have been raised. I'm giving you the opportunity to put fresh logs on the fire.
Well, maybe one that
no, that was for Michael Gratz. That wasn't for you.
Sorry, I'm still Michael. Oh.
Mick and Michael, right?
Yeah.
Oh, we had this problem with our group. We had a third Michael, right? So,
That's true.
Is that why Gratz had to leave?
That's one of the reasons. So I did post, David has seen these, but no one else has. I did post a group of slides. There are 43 slides called the known unknowns of the business tax reforms proposed in the House Republican blueprint, in which I acknowledge that Donald Rumsfeld was a better epistemologist than defense secretary. But there are 43 sort of things. Some of them are things we won't know even once the tax is enacted, I think. And some of them are things that we'll know as we go through the legislative process, implementation kinds of issues. And many of them, as you say, have been raised. I have to say, I'm worried about this. I guess I am the only lawyer on the table, and we had a couple in the earlier panels, but I'm really worried about this because it is a unique tax unknown anywhere in history or in the world. And so it seems to me it's a risky proposition in many ways. For example, when Kim says, oh, well, we could have a 40% rate instead of a 20% rate, I immediately think, and since it's a tax inclusive rate, then not a tax exclusive rate for the those who know that language. Instead of exchange rates rising 25%, they'd have to rise over 50%. I think the rate matters. It matters for very different reasons than it does under an income tax. I'm quite worried about a 25% appreciation in the dollar, particularly on sovereign debt of countries like Malaysia, Turkey, Indonesia, Mexico, always Mexico, who have denominated their dollars in their debts in dollars, and also many non-financial corporations that have denominated their debts in dollars because people don't trust their currency. They'll immediately take a huge hit, which will depend on the rate of the tax. That is, if you believe exchange rates are going to adjust. It's going to be a combination of prices and exchange rates. And as I hear Mick, he says, we're not sure exactly what that mix will be. Alan is greatly confident about the incidence of this tax, and I have to say, as a non-economist, I'm a little confused about it because I keep worrying if prices go up, do I have to pay more out of my wages for those prices? And then Alan says, but your wages are going to go up because of the wage subsidy. And I think, well, gosh, I can't wait to talk to my dean about how my wages are going to go up. But then he said, but we've already got a wage deduction under the current law. So, so I worry. So we're now going to allow a deduction for capital goods, immediate expensing. So I'm thinking, well, I'm a business person. I'm equal between a robot and a worker. Before, I could have deducted the worker, but not the robot, right? Now, I admit I'm a lawyer and not an economist, and so I keep asking questions, and they have all the answers, and so that seems to be where we are, and that's okay. But I think a lot of people are asking these questions, and I think one of the reasons people are asking these questions is that there is no tax like this anywhere in the world. And as Alan would be the first to tell you, people like David Bradford and others have been arguing for this tax now for more than 40 years. So it's not like it's some new idea that hasn't been enacted. It's an old idea that's in new clothing. Let me just say one other thing from a lawyer's perspective. Ty was being very political or gentle or whatever, and described that there is an equivalent to this tax that you could have that would not violate the WTO. I just want to explain that to those of you who may have missed the subtlety. This tax violates the WTO, and the WTO will say so. And I'm a little worried about how we react when our trade negotiations with 163 countries are now thrown into the balance because we've created this situation. And what Atai did not say, but might have said if he had more time, is that there is an issue about whether it also violates our bilateral income tax treaties with 68 countries. And there are two possibilities, I think. One is it violates those treaties. The other is it's outside the scope of those treaties. If it's outside the scope of those treaties, then that's because we have no corporate income tax, I suppose. Then do we think that those countries are going to allow U.S. multinationals to deduct the royalties that they pay to the U.S., which will not be taxed in the U.S. under the DBCFT because they're exports, without imposing either a withholding tax or a denial of deduction? So that there is one of the big unknowns for me is how other governments are going to react. And I have to say, with our current government, I have a newfound uncertainty about how our government might react. I would have been confident about how either President Bush would have responded to a WTO dispute. I hear President Trump saying the WTO is a disaster and we ought to negotiate our trade treaties bilaterally. okay, that's 163 countries. We're going to get a good deal from each one of them. Not in Mr. Trump or my lifetime, I fear. So I think this is a big problem. One last issue, and I'll stop. State and local governments. This is one that has not come up. State and local governments all have corporate income taxes. Where do they have I go back to Lily's CCCCTB. Where do they have a common consolidated corporate tax base? Answer, in the federal tax system. So all the states start from the corporate tax. The federal government repeals the corporate tax. The states, which do have retail sales taxes and have their own consumption taxes, are going to have an issue about what they do about corporate taxes, and they can start competing with each other, and then we can have a European
competition.
A European Union. We could have
Kim, let me ask you about, so if you acknowledge that there are problems with the U.S. way we tax business, and if you'll concede that if you can do something at the margin to make the U.S. more competitive, that is to attract more economic activity here, it would be a good thing to do. I take your point that taxes may not be the only or even the most important factor. I think what the spirit of the the tax is that we have had very little success in making modest changes to the business tax. The politics of that seem difficult. We have a serious problem, and yes, we are talking here in the realm of the ideal. We all know that when the legislative language is written, it'll be far more complicated, and some industries will be carved out, and there'll be transition rules and all that. That's the nature of any tax reform. But what would you do instead if you don't want to make the kind of wholesale change?
Yeah, I think we already have a pretty good outline of what might work instead if you build on some combination of Camp's proposal from a few years back and the Obama administration's proposal for business tax reform. And I think that those packages basically involve a lower corporate rate, but combined with more serious base erosion measures. And the one that I find most attractive would be the per country minimum tax. And the nice advantage of a per country minimum tax is you could get rid of all the profit shifting that way too. Because my work and others' work suggests that all the profit shifting, or 98% of it, is happening with respect to countries with less than 15% tax rates. So if you have a per country minimum tax that's payable currently, then there's no incentive to move income to those tax havens anymore. And the great thing about that, as I show in a paper with an IMF economist as a colleague of Mick's and also Ed Kleinbard, is that helps rather than hurts our trading partners, which might be a nice thing given the current political climate. Because if a multinational firm isn't putting a lot of money into Bermuda, that helps the U.S. tax base, but also helps the German and the Japanese and the other tax bases that they might be shifting the income to Bermuda from. And that's off the shelf, ready to go, doesn't require a lot of worries about exchange rates. And I'm with Michael Gratz in being concerned about the sort of sovereign debt angle there too, because one shouldn't be sanguine about a massive dollar appreciation that involves a big wealth transfer as well as risks to the world economy through emerging markets. So I think this minimum tax thing is ready to go with a lower tax rate, and that would go a long way to solving the profit shifting problem.
Kevin, can you give us what you think are the biggest advantages and biggest risks of going to a destination-based cash flow tax?
Oh, sure. Yeah. So I think that a big advantage is that the compliance is much simpler. So I kind of remember Joel at one point Joel Slemrod did an estimate of the compliance cost versus the revenue, and it turned out that the compliance cost was higher than the revenue for the international tax, or close, right? They're pretty close, and so that you no longer have to, move your tax return around with a forklift. I think that, we're talking about the neutrality of the code, which is, attractive, after it's there. But we're starting out with a code that's distinctly not neutral, that encourages you to locate activity offshore, transfer the, prices, the profits there, and And so if we go from a really not neutral code to a more neutral code, then it should, have domestic benefits. The plan also encourages the location of activity for foreigners that have economic rents that they would want to locate them in the U.S. And that should also be a positive for us. And moving towards a consumption base is something that back when I was working on the Fortran code of the Auerbach-Kotlikoff model in grad school, that there's a lot of documentation of the positive benefits of that, and so there are a lot of good arguments. I think that Michael is right that transition risks are things that really need to be closely paid attention to. The dollar appreciation is one. The debt. What do you do about existing debt? How do you grandfather it? That there are a lot. If you don't grandfather it well, then you could really mess things up. You could imagine that there'd be a lot of bankruptcy and so on. And it reminds of the '86 Act in that regard, where they didn't really think through what would happen to non-residential real estate as carefully as they could have in retrospect. And so I think that those risks are definitely there. The foreign exchange one. So on one side you could say, well, those markets are really volatile. One of the things you see sometimes is you're worried about like the change in the gas tax. Is it going to have a really big effect? And you notice that the price at the pump varies every month by more than what they're talking about, the gas tax or something. And so then you think, okay, well, how bad is it going to be? Well, the foreign exchange markets are really, really volatile. You go look. But the thing that so then you might say, okay, well, so they're used to big fluctuations, and so therefore they ought to, be okay. But on the other hand, this is a really concentrated one that hits everybody at the same time, and that's the kind of thing that in the past has led to instability in financial markets. We could think of the Asian crisis as being an example, Latin American debt crisis, and what happened to the currencies then. So I think that those risks are significant, and that one would hope that for many of them that prudent transition rules would ameliorate them.
And a question came up earlier that I know you have a good answer to, so I'm going to ask it, which is, okay, so the economists tell me in the long run there's no revenue from this thing, because in the long run we can't run a trade deficit forever, and we can't run a budget deficit forever, so someone's going to have to pay for this, so the present value is zero, so relax. And then the scorekeepers say, this is a great tax because we get a lot of money over the next 10 years that we can spend. So who pays where's the money coming from over the next 10 years?
Yeah. I think that many of us in the room have been frustrated by American citizens' inability to internalize the transversality conditions of our models. But I think that and I have to say that I've spent in the last few months, I spent more time reading Mick Keane's work. That just go to Google Mick Keane, look at his working paper. He's got papers he doesn't even remember that have really helped me think through all of this and the exchange rate movements and stuff like that. But the way I think about who pays, which I was sort of taught by Alan Viard, who wrote a recent piece about this and who's in the room over there, is that. That a way to think about it is that if the dollar does appreciate, which is what we think happens in the model, then if we have a trade deficit right now, so it's a current account deficit, it has to be financed with a capital account surplus. And the capital account surplus is, they're buying, say, U.S. bonds at appreciated dollar and then getting interest at an appreciated dollar. And so really you could think of it like we're borrowing the revenue from the people who are financing the current account deficit, and anyway, that's where the revenue comes from. That's why it's not.
So the Chinese buy U.S. treasuries. They have to pay at an appreciated dollar rate, but they get paid back
in
appreciated dollars. So are they indifferent to this?
Well, yeah, because that's why they bought the bond, right? Is that they yeah.
Well, wait a minute. I mean, I'm not an economist, but if you've got a U.S. holder of foreign assets and the dollar goes up, that person just lost a lot of money. I think it's $8 trillion at 25%. And the reverse is true. If a foreign holder of U.S. assets, if the dollar goes up 25%, they just get 25% richer, right? Mm-hmm. So and that's, I think, based on current numbers, about $6.1 trillion. So there are huge wealth effects that are going on that will vary depending on who's holding assets where and who's holding debt where.
Mm-hmm. That's great.
And so
That's correct.
I just
too.
wanted to be sure about that.
Both things are true. One doesn't negate the other.
Okay, I didn't mean to negate it, but I just didn't want to leave it off the table. Can I just make one comment about Mick's point about not having clean VATs? So, look, I'm a person who believes that we should lower our corporate tax rate a lot. I believe that high tax rates attract debt and low tax rates attract income, and so we've got this backwards. And that we should have a value-added tax. And if you look at what other countries have been doing by competition, they've been raising their value-added taxes and lowering their corporate income taxes, and we don't have that instrument available to us. And tell me why. But the problem I'm having with some of this discussion is we're comparing sort of the messiness of a real-world corporate income tax, the less messy, I would argue, value-added tax, putting Europe aside, but the modern VATs, which Mick, you know a ton about, to an imagined DBCFT, which Congress it's going to go through. Isn't it going to go through Congress as well? I mean, I'm not making a point about. But we can't just assume that Allen's blackboard version of the DBCFT is the one that Congress is going to enact. And this goes back to a point that Atai made, which is a very, very important point that those of you who were not on the President's Commission may have missed. And that is, that you've got to have very tight rules that are similar to the invoicing requirement in VATs in order to make this thing come together. And if you just put in exemptions in the DBCFT, let's say I read one in the paper that a spice company wants an exemption for spices because we can't grow spices apparently here. You have to grow them in spice countries. And so you put in an exemption for spice, that will then work its way through the system if you don't require invoices. And so I'm just worried about, I'm thinking agriculture, real estate.
But Michael, you have a tax reform proposal.
Yeah.
And you didn't present to us the post-Senate Finance Committee, post-Ways and Means version. That's true. That could be an argument against ever doing tax reform.
Well, it certainly stopped us so far.
Touche.
I concede.
Surrender.
I concede in my book and in my articles urging a much lower rate VAT to lower the corporate rate than we're now talking about. I concede that there are better and worse VATs, and that if the CBO estimates a broad-based VAT, which I would say would be a better VAT, and it estimates a narrower-based VAT, which would be a worse VAT. Either of those, I might add, would move us in a position where we were able to have more instruments of the sort that are pushing us toward this DBCFT, and enable us to adjust our rates and our individual taxes. Somebody asked about inequality. I don't think of the corporate tax. I guess this is where Kim and I differ. I don't think of the corporate tax as particularly good at addressing inequality because of the mobility of the issues that we've talked about, including intellectual property. I think that shareholders are much less mobile, and so that the progressivity at the capital end ought to come from individuals based on where they reside, and that's the only sort of, I think, stable way to deal with issues of progressivity. So the fact that this particular tax may be a little more progressive than the value-added tax and a little less progressive. You've got to look at the system as a whole.
Mick, there seems to be a general sense, at least among the economists, that it would be a good idea to tax rents, that we can build a tax system that doesn't tax normal profits. First of all, for lay people, why? And secondly, if we weren't going to do the DBCFT, what would be other ways that we might think about taxing rents?
Right. So rents, one can basically think of as the return to investor in excess of the minimum they need in order to undertake the investment. So it's kind of a kind of excess or super normal profits. So the idea in the simple cases, you can pretty much tax those at whatever rate you want. You're still leaving the investor more than at least the minimum they require to undertake the investment. So the investment still kind of goes ahead. Also, particularly clearly in the form of the cash flow tax, this also means we get around problems with distortions to the choice of financing. So if you think about the cash flow tax, where the system is neutralized between debt and equity finance, which is an important feature, I think, because certainly one of the things that we've been worrying about at the fund increasingly is the kind of financial stability implications of these tax incentives to excessive debt. So it has all these kind of nice neutrality properties, and I think I was happy not to be asked a question about competitiveness, because I think economists much easier to think in terms of neutrality and kind of efficiency, and I'd like to. I don't have that many papers, but I think the word competitiveness does not appear in any of my papers, except one co-author who put it in at proof stage without telling me. sadly in the title. But there are other ways you can go about taxing rents. Another one is based on the allowance for corporate equity approach, where instead of essentially instead of eliminating interest deduction, you also give an allowance and kind of an allowance for a notional return on the equity invested in the company. And in a way, one surprising thing to an outsider in the debate is actually that's not given in some sense a bit more billing. I mean, Kim worked on that in her work. I know Alan's thought about this. We've discussed it a little bit, but you can say, well, the ACE. We don't have to worry about interest deductibility because that carries on. Possibly we can keep depreciation allowances, so we don't have so much. Possibly the losses aren't such a problem. So there are various ways you can do it. I mean, the attraction of the destination base is that when you think, for example, of the alternative of an origin base, where you do tax the return to, you do include the sales from exports, you do give a deduction for imports. Basically, that's where all the transfer pricing issues come about, is the interactions you get there and the incentives to locate kind of a lumpy investment in one country rather than another. So there are other ways you can do it. And I think maybe to segue into another point I wanted to make, there are countries that have rent taxes, not destination-based cash flow taxes. But if you think of resource-rich countries, that's pretty much the standard advice for many of these countries, is to have some kind of rent tax, maybe with royalties as well. And I think that's actually important to bear in mind in this conversation, that I think whatever we envisage, if we think about how other countries might think about this, many of them are resource rich. They're going to want to retain some source taxation in relation to that for sure. And for that, we're still going to have, then I think that, amongst the issues, I don't know if it was in one of Michael's 49, but it's thinking about the links with how you tax natural resources, which I know is something we've talked about, and location-specific rent, whether you kind of have a carve-out, have some kind of ring fencing of resource in the rest, whether we can have some kind of grandiose arrangement that includes the resources as a special case. All these kind of interaction things, I think, are things to think about, which lets me make one quick point I also wanted to make sure to get in, is just the importance of these issues for developing countries when we talk about tax competition. It's come up a couple of times, but maybe in a slightly dismissive sense. But it's worth bearing in mind that these tax competition issues are, if anything, more important for low-income countries than for high-income. If these countries are getting more of their revenue comes from the corporate tax than it does in advanced economies. They have nothing else. Where else are they going to go if the corporate tax goes away? The VATs are pretty much all stretched. They haven't got a proper income tax. We don't want them to go back to tariffs. So I do hope that within this whole, both the intellectual and the kind of political debate, we bear in mind that these spillover effects, which Alan mentioned, can be very strong. These do impact, some of the most vulnerable countries in the world.
Okay, Kevin, I'm going to ask you one question, and then I'm going to turn to the audience, and if there are not more questions, I'll keep asking. That way we can be sure that we get everybody who wants to ask a question in the audience give a chance. But Kevin, so a lot of the people who are nervous about this they might take your point and say, yeah, we might want to get someday to a destination-based cash flow tax. And there are some advantages to being a first mover, But when the first mover is the size of the United States, it could really have, as Michael said and others said earlier, the backlash from abroad could be pretty severe. And I think that I noticed that people divide into about two camps on that. One is the backlash will be so severe, the danger of blowing up the world trading system is so great that actually the WTO will never hear the case. It'll just never happen. And the other is, well, what do we get out of the WTO anyways? Maybe we ought to use this as an opportunity to rethink how we do everything. So how do you think about how the other countries would react, and how much would you be willing to risk blowing up the world trading system?
Yeah, that's not my call, but yeah, the foreign sales corp litigation. I mean, we were doing something pretty legitimately wrong at that point, right? And it took them 7 years to rule. And how
Jane says 30 years.
I mean, almost, yeah. But each step of the litigation was very lengthy, and Mike Devereaux has studied this way more than me. He spoke at an AEI conference a few months ago where he said he thought that if we move first, that everybody else would follow relatively quickly. He said that the UK would go this year if we moved. It's not something that, so one thing I have studied, and this is a paper with Aparna, is of course a lot more because there's so much data on it, the corporate tax. And the one thing that we do know is that the corporate tax reforms are really highly correlated, and we have this paper where we were able to predict out of sample corporate tax reforms when countries, neighbors as defined in the kind of and case way, like so the countries that are like them, when they cut their corporate rate, then when your neighbors cut their corporate rate, then you cut your corporate rate, and the responsiveness is really quite.
So your basic
dramatic.
point
It's
is people would be more
significant.
likely to copy us than fight us.
If we cut our corporate rate, then we'd be pretty late from the analysis that we've done. So everybody else has moved and been playing this corporate tax competition game, really for a couple of decades while we've been sitting on the sidelines. And so our model thinks that we should have had a big cut of the corporate rate a while ago. And so we know that kind of competition exists. As Mike says, we don't have any data on what happens if we switch to.
All right, so I want to ask a question of everybody. So 2 years from today, that is, we've had, this Congress has finished. How many people think the president will have signed into law something that looks like a destination-based cash flow tax? If you think, how many people think it's likely to happen? Raise your hand.
What falls within the category
As generous as you want to be, given that so far it's Auerbach and Samuels who've raised their hand. How many people, some people may not have opinion, how many people think this is an interesting intellectual discussion and we won't see anything like this in the next 2 years? So I'd say a lot of people don't have an opinion, but more say unlikely. Okay, so I'm going to offer the floor to questions, and as I say, if there are not enough, we'll come back. There's a gentleman over there, and there's a woman over here. One of you can go to the mic, and the other one can take the mic. Oh, whatever. And tell us who you are, please.
David Brazel. I have a dream, and that dream is, let's say Congress gets together and actually decides on tax reform, and they've read Michael's 48 or 49 things that make them a little bit tentative about replacing the income tax, the corporate tax, with a DB-CFT. Let's say they say, let's go part way. I'm going to buy down the corporate rate with this kind of destination-based cash flow tax at a lower rate, with the intention perhaps of, once we see how it works and we see all the kinks worked out, we're going to then raise the tax, lower the corporate tax, and gradual replacement rather than all at once. The problem I see with that is that every time you raise the rate on the cash flow tax, is that you're taking away the neutrality of the tax, because now you're taxing returns at a higher rate than they were deducted at in a previous year. And that might work once or twice, but pretty soon people are going to catch on and that tax will no longer be neutral. does anybody see a way around that
Okay.
in a way to
Why don't we
introduce
take
the
the
text?
second question here, the woman here, and then we'll let people respond.
Hi, I'm Uzma Ashraf. I'm just thinking about the objectives, for example, of this text DBCFP. What I can think about is maybe there are 2-3 different objectives. That's like one probably is to lower the corporate tax rates, to increase the size of the revenue with the government. The other could be to increase the size of the pie, which Ron was this morning suggesting with the pie, but I'm understanding that the pie is the welfare pie for the U.S. domestic consumers.
Mhm.
And if this tax is going to increase that pie, the size of that pie, and I'm supposing that I forget about what's happening in the outside world, what's happening in Asia, the volatility, the external volatility, whatever. But I'm looking at the domestic effects. So how much the pie would increase for the domestic consumers from this tax? Does this model take any calculations over the next 10 years or in the longer term, how much the domestic users are going to benefit it? I mean, we hear a lot about the job increases and the import taxes and all that. But at the end of the day, my understanding is it's like the domestic consumers are going to pay in terms of higher prices.
Okay, so there are two questions. One is kind of, can we drag out the transition? And was there a way to do that? Does anybody have a view on that?
Well, I mean, I would say two things about it. One is there are ways to do this that are lower value-added tax types and keep some of the corporate tax. Either they could be separate, right? I mean, you could lower the corporate rate and have a 5%. You get basically the same place with a 5% value-added tax of some sort and a 15% corporate rate. That's much less disruptive to existing arrangements and the kinds of things. It keeps the corporate tax in place for treaties and so forth, and assuming the VAT were done in a way that's trade compliant, it wouldn't be nearly as big an issue. The group that Alan and Mick have been working with for some time also have a proposal which has not yet been published, but I know about it, which is for something that they call a residual profit allocation. They've talked about it at the TPC and at Oxford, which basically keeps the corporate tax, provides a regular rate of return, whatever that might be, a normal-ish rate of return on R&D and on manufacturing and on financing, and then allocates the remainder, the rents, if you will, or the IP profits to the country of sale on the grounds that that's where those IP profits actually should be located under appropriate transfer pricing. That gets you a lot of the way to some of the benefits that people are looking at in this tax, without any of the disruptions. So all I'm saying is there are many ways to think about transitions, and there are many ways to think about, if not endpoints, points along the current legislative path that I think that would solve the largest concerns. The question for me is always, in a political context, how exactly that reasonable option
Thanks.
emerges and gets enacted.
Kevin, I want to reframe the second question this way. If I'm a member of Congress and I'm in the top quartile of intelligence in the Congress, and I've heard this discussion, I'm a little confused. The economists tell me this is just a great way to get more growth in the U.S., and the dollar will adjust, and it's not really going to change the trade balance at all. And I hear from a lot of my constituents who are multinationals that this is really something to do. It'd make the tax system better, get rid of a lot of the games. And then the Walmart crowd comes in and says, this is a lot of economic theory, and basically we're going to raise the prices at every Walmart for every one of your constituents. And so if the member of Congress said to you, so help me understand, for my district and the people who live in my district, is moving to a destination-based cash flow tax going to make them better off or not? Or do we even know?
Yeah, I think that we know that, and this goes back to something I've been working on for more than a couple of decades, that the current corporate tax is extremely harmful. That if you look at typical Rust Belt type places that used to have manufacturing activity and don't now, in part because of taxes, not just because of taxes, that there's a lot of reason to be hopeful that if we get the corporate rate down, and if we do it by just reducing the rate, or if we do it in this manner, that there's going to be a lot more activity that gets located in the U.S. because we're no longer chasing it away.
But so, if I'm a member of Congress, should I say, well, I don't know, this seems kind of complicated, some risks on the dollar, I'd rather go with Dave Camp. Will I hit the same benefits?
No, but I mean, the Camp bill is another thing, and there are a lot of details that we'd have to talk about for that. But could we conceive of a corporate tax reform where you just played with the rate and a few other things without border adjustment, where you would run it through the model and get the same benefits? Of course. Yeah, I mean, because there's not just one way to get there. But the fact is that, as Mike says, he's sort of dreaming of, if tax legislation is sausage, you're dreaming of like vegan sausage, right? That is very virtuous sausage. But the fact is, we've not had.
I think I'm going to retire that metaphor. I don't think that one works. It was a nice try, but
no. But the point is that the corporate tax hasn't been reduced, and it's
Right.
been very, very harmful, and we need to find a way politically to do it.
John Samuels,
Vegan sausage.
can someone bring a mic over here? Well, I think that some people are watching on, you have a big audience here,
Who decided to give Samuels a question?
I did.
So I first have a response to the question about transition, which I think is a good one. What you could
You want to
do.
come up here and
No,
Don't
because you didn't give it, Michael. What you could do is go to a cash flow tax, but have it be part destination based and part origin based. You don't really need to have the tax initially be fully, so 50% of imports could be non-deductible and 50% of exports exempt, for example. And that's a way to put your toe in the water. I want to just raise a few points about the WTO issues. First, one thing to note, which we tend to forget, is the WTO doesn't apply to services at all. So there is no WTO issue on services, and we're a big, I think we have a net surplus in services. This doesn't apply. Secondly, on the question of is it WTO legal or isn't it WTO legal, I think it's a very good question. As Michael said, it's a lawyer's question. But there's a history here which is important. The first introduction to what kinds of taxes could be rebated at the border and what could not on the WTO was in 1955. And then in 1960, we agreed to allow VATs to be border adjusted. At that time, VATs were rates of 2 to 4%, and they covered only 1/6 of traded goods. Countries had tariffs, they didn't have VATs. Over time, countries started to raise their VAT rates and reduce their tariffs, and the U.S. woke up. And they started in 1968 with a GATT working party trying to say, can we reopen this discussion about what kinds of taxes are border adjustable and which aren't? They were rebuffed. We then tried to open this negotiation up in the Tokyo round in 1974. We tried to open it up in the Uruguay round in 1988, and most recently in the Doha round. Always rebuffed. Now, maybe it doesn't matter if the exchange rates adjust. Why do we care? But the point is, what this could do, instead of leading necessarily to a controversy, it could lead to finally being able to renegotiate what kinds of taxes should or shouldn't be border adjustable, if I believe my colleagues, the economists, who say there is no current economic basis for the status quo. So I think...
Okay, thank you. Alan Viard, your name was invoked. Do you want to say anything in your defense? No? Okay. Mike Smart?
I wanted to ask some questions of Mick Keenan of the panel about the issue of resource taxation that he raised. You took me so far, I understood you up to a certain point. It seems to me clear that resource exporting countries are going to be reluctant to adopt a tax like this on a destination basis. There will be strong incentives to retain taxes on an origin basis, your country like that. And so Mick said, well, that's an issue. Maybe we can figure out how to ring fence regimes of that kind. And I just don't see how that works. I think it fundamentally doesn't work. I'd like to hear more from you. The thinking in my head is that the problem is you can ring fence the tax regimes, but all these firms are trading in the same exchange markets and they're competing in the same labor markets domestically. If the fundamental mechanism in Alan's tax proposal is that we're going to raise domestic prices and domestic wages in a way that offsets the border adjustment, I think that fundamentally breaks down if you have a large sector that's being taxed on an origin basis. Particularly, I come from a country that, I mean, whether you know it or not, Canada is basically, it's a petro state that also produces cars, right? And so, how is this going to work if Canada decides to go ahead with this proposal, but exempts the resource sector from the destination-based treatment? It seems to me you don't get the exchange rate effects. You do get the border adjustments, and the result is that Canada is exporting cars for 25% less than before. How will President Trump respond to that?
I'm not going to answer the last part of or even the first part. No, I think about it. I mean, you're certainly right. Clearly, all the kind of equivalence propositions and so on that relate to the DBCFT assume that every activity is subject to the tax at a uniform rate. All these results break down. So it's certainly true that if you carve out a sector, could be resources or any other sector. If you carve it out, all the neutrality results in relation to the border tax adjustment apart, if you just apply that to a sector, it's going to be out the window. And I'd have to think through, President. You're quicker than me at figuring out exactly what that means for particular sectors. I think when I talked about carving out, that was in a much more kind of mechanical sense. That is, whether we want to live with the kind of resource tax regimes we have in many countries, which are not really proper resource taxes, or not really proper rent taxes, or whether we want to think about it in a much more mechanical sense, some overarching system that combines origin and destination-based elements perhaps for not just resources, but I guess for anything where you think there are some location-specific rents. I think that's kind of ideally how you'd like to do it, but I think we haven't sat down and figured that through. Or maybe Alan has.
Can I ask a question about this? Just on the DBCFT, assuming you apply it to oil, which is priced in dollars.
Okay, so can Mike?
But
Well, let him ask it before you answer.
maybe some other people don't.
Can you bring the mic over to Howard back?
No, the question is doesn't the domestic price that you get for selling oil, for example, which is dollar denominated, have to be 25% greater than the price of exported oil? Because you're going to pay tax on the price that you get domestically, but you're not going to pay tax on the price that you export. And is there going to be a wedge between the domestic price and the? So you can answer that now that I've asked it.
Okay, so the first answer to Mike, there's too many Michaels here, but in answer to Michael Smart's question, if you take a DBCFT and you apply it uniformly, and then you have an additional tax on natural resources, there's really no problem. I think you were thinking about a situation in which you somehow try to exempt the sector from the cash destination-based tax and then replace it with a source-based tax. And that would result in a mess, which you characterized correctly. But I don't think there's any such problem if you just put a source-based rent tax on as an add-on tax to this system. And I think when we've talked about that in our group, we've sort of contemplated to the extent that you can identify and measure and not worry about source-based rents without worrying about transfer pricing or anything like that, and you're a resource-rich country, that's something you should think about doing, and it's complementary to this approach. It's not really a substitute. In answer to Michael Gratz's question, that's going to be true. I mean, think about what happens under a VAT. There's a producer price and there's a consumer price, and if it's inclusive of the tax, it's going to be a higher price than not. And it's not in any way distortionary. That's just the way it's going to be for any goods, not just for oil. The question I thought you were going to ask was, doesn't the fact that oil is priced in dollars somehow damage the exchange rate argument? And the answer is no, because it affects existing contracts, obviously, which have a fixed dollar price. But going forward, we negotiate terms of an agreement, and whether we then say, well, let's measure that price in dollars or euros or any other currency is irrelevant.
Nick?
I knew the answer to that question, too. As we say in the law, for the record.
Mick, can I say something? And there's that woman in the red dress. If you stand up, they can bring a mic to you.
Okay.
Oops, sorry.
Very briefly, I just wanted to pick up on something Alan briefly mentioned, which of course is once you retain a kind of an origin-based element in the system, we have all the BEPS problems again. I mean, the BEPS problems will stay for that sector. So, the idea that we're going to wipe out all BEPS problems, even if we all adopt it uniformly, it's not true. So when we, as we probably would, carve out some degree of origin taxation.
Ma'am?
Hi, my name is Jennifer Hillman. I teach here at Georgetown in the international trade arena, and in my past was a member of the WTO appellate body, so have some familiarity with how the WTO might look at these. And my question really wants to come back to this issue of WTO legality. And for me, the debate, I think, has been very confused because people are conflating the disciplines on imports with the discipline on exports. And to my mind, at least, they are quite different. The disciplines on imports are very clear, so there's no ambiguity about it. If you put a tax on an import that is even 1 penny more than the tax that you put on the domestically produced product, that is an unequivocal violation of our WTO obligations. And the tax proposal that it's pending before the Congress is to do exactly that, to tax imports without allowing a deduction for wages. So the tax on imports would cover the entire value, whereas the domestic tax would allow a deduction for that portion that is attributable to wages. So there would be an absolute, unequivocal, no doubt about it, violation of our WTO obligations on the import side. On the export side, I think there can be a lot of very genuine debate, and that's exactly what happened in the Fisk situation about whether or not an export tax is an indirect tax or a direct tax, whether or not its value does or doesn't create a subsidy for exports. So I think very legitimate debate about how that would be regarded. But I think there's no ambiguity about how the import tax would be regarded. And if you look at the estimates of what the amount of retaliation that would be permissible, the most recent numbers would show a number in the order of $220 billion of permissible retaliation by our trading partners, which again I think puts it into a completely different category than Fisk. So if that's the case, if it is on day one a blatant, unequivocal violation that could subject the United States to retaliation, and presumably quick retaliation of up to $220 billion, where then do you see the risks, and how essential is providing, how essential then is providing
the witness, Counselor.
but how essential is providing an import tax that does not permit a comparable deduction for wages or other things so that you don't have it as a discriminatory tax?
Kim?
How critical is that to moving forward with this kind of
I just want to make
proposal?
one quick comment, which is that point is why I said you're going to lose in the WTO. It's just, I agree entirely with
Kim?
the legal analysis.
Yeah, so I do think this is a big risk, and a couple ways of thinking about it. When the WTO rules against you, you've got choices you can make. You can either comply with their ruling and change your law, or you can face the retaliation. And both of those seem somewhat problematic, because if you face the retaliation, right, then the trade effects of the retaliatory tariffs are likely to far outlast any period of exchange rate adjustment that we're waiting for. So you're potentially left with a very damaged trading system, and I don't take that lightly at all. If you change the rules, if the WTO rules against us, and we could argue even cynically that maybe that's part of the plan, and that then, that once they're ruled against you, at least Shepard made this argument, that you just remove the wage deduction and you've completed the transition from a corporate tax to a VAT. And I would be myself reluctant, because I do think the well-designed corporate tax has an important role to play in taxing capital, and I wouldn't like to see that entirely transformed into a consumption tax. That's one option. Another option is you could get rid of the border adjustment, but then that it doesn't work. Then you don't have any of the positive benefits associated with the tax because you've opened the door to tax avoidance and you've lost a lot of revenue. So I don't think any of those outcomes are things we should view with happiness.
Kevin, I took your answer to this to be, it's not going to come to a confrontation with the WTO, that there's at least it's not the only way it goes, that there could be, that we could spark a change, either as John suggests, in the way the WTO looks at these things, or that, it'll just become conventional to do a tax like this.
I'm not an expert on WTO law, and the one thing I could say is that we've seen that there are ways to construct it. I think John has studied this a lot, but there are ways to construct it that are WTO compliant. So if you have a VAT and then the payroll tax reduction, and that they're mathematically identical to this. And so the notion that we would have a law, it could be true that we have a law where there are two mathematically identical things that the law rules.
We call it the
in different
tax
directions.
law.
No, I'm just saying that if it's mathematically identical, then you would hope that the law would
That's true
treat
of
them the same.
financial
It's,
instruments and
maybe
all
that's
sorts
a
of other
obscure principle of law.
Well, but I agree. I'm kind of sympathetic with your view, Kevin, although it does seem to me that the politics of this is that the success of this tax rely on convincing at least one person in the United States who has a very powerful position that it is a tariff, and convincing everybody else that it isn't a tariff, and then everybody will be happy.
So I have a question actually for the trade.
You want to appeal the WTO decision? Yeah, okay.
So my understanding is that this $220 billion countervailing duties that other countries could impose against the United States would be prospective only. In other words, if the WTO rules against us, we have a cure period, which, as Kim suggested, might let us get rid of the wage deduction, do other things, so that we aren't really putting ourselves at risk of an immediate $220 billion.
Again, assuming all of our trading partners are saying they will continue to follow the WTO rules. I mean,
Well,
that's
sure.
that's sort of
Sure.
obviously the concern would be if we are arguably blatantly violating the WTO rules right out of the box, whether everybody else is going to say, well, I'll still follow all the WTO rules and go through the process. But you are correct. The way the process would work, you would have to first have a ruling that the United States' tax law is not consistent with the WTO. And like I said, on the import side of it, if the tax were as it is today, I think 100% chance that that would be the outcome. Then arguably you can appeal that decision, so you're buying more time. Then you are making some change of some kind and saying, now we are in compliance, and then you then can have another challenge on whether or not whatever you have done to come into compliance in fact brings you into compliance. So again, yes, the process can go for a while if there is appeals at each one of these stages. And these days, the caseload is very high at the WTO, so the cases are slowed. Could be 4, could be 5 years before a formal authorization of retaliation were.
But can I just ask, you started with something that I wasn't sure that necessarily the assumption that one should assume. So that assumes nobody retaliates in anticipation.
Correct.
Because I'm another country, they want to break the WTO rules. Fine, I'll break the WTO rules too. I'm going to impose some tariffs, and then you can sue me, and I'll sue you, and you could
Exactly.
cascade.
In other words, if you're going to follow the WTO rules, then I think the retaliation wouldn't be authorized, and the United States does everything it can procedurally to drag it out as long as they can. I think retaliation wouldn't be authorized by the WTO for 5 years, could even be more if again, you keep dragging it out. So 5-year window, I think, before realistically a country would be authorized to retaliate, if they're following the WTO rules. I think the risk is whether countries are going to say, since you're not following the rules, I'm not going to either. I'm going to retaliate immediately. That's would be my sense of the risk.
So with all due respect, I'm not sure anything's 100%, because I heard a trade lawyer at a meeting, I think 3 weeks ago, very respected trade lawyer, saying he's not sure whether this is, and Michael was with me.
It's not the way I heard him either.
Well, he said he thought, he said he thought we might lose, we might win, we might lose. This would be a case of first impression before the WTO. but it wasn't a slam dunk out of the box.
Well, I think we can
think-
establish that you can, the chances of getting unanimity among lawyers is at least as rare as getting unanimity, especially with those who have clients, is at least as rare as among economists, some of whom have clients. I think we've run out of time. I want to thank the panel and the audience for what was a really interesting discussion, and to thank the IPTF and Georgetown, because the fact that so many people stayed in the room so long for a discussion of taxes is just a sign of where we are. And will someone tell me you want to tell me what the directions are for lunch and Kevin Brady and all that?
We're just taking a little break now. Chairman Brady's on his way, so
Okay.
starting in about 15 minutes.
So should
Okay.
we have lunch afterwards? Or?
Lunch is after. That is in the program, I believe.
Okay, so,
Lunch is
In
after.
order to protect air.
okay, well, if anybody, so we can, what?
Announce lunch is after.
Lunch will be after Kevin Brady, so you don't get a free lunch unless you stay for Kevin Brady. I'm happy to take a break, but if someone has a question we didn't get to, we can fill the time a little bit, or not.
Copy it there in the case.
Okay with that? So I think you should stay close, because when Kevin Brady comes, we don't want to spend 20 minutes getting everybody back in their seats. Thank you.
I'll take that.
So we've had a great morning of discussion, but it's going to be capped off by, I'm sure, a terrific talk from our luncheon speaker, and who probably needs no introduction to this group. Kevin Brady, the chairman of the Ways and Means Committee, which is the, without question, most powerful committee in the House. It has jurisdiction over not only tax, but healthcare, trade, Social Security. But we're talking about tax today. We're delighted to have him here for two reasons. One, as we said earlier, the initiative Kevin Brady has taken on tax reform has made all of us much more important in our companies and our universities and academies. Tax is all of a sudden, in fact, the chairman of my company refers to me as the it girl now. So I'm enjoying the limelight while I have it, as you should. And that's because of the bold and innovative proposal that Chairman Brady and Speaker Ryan are advancing to really transform the U.S. tax system. And we understand, we talked this morning about a lot of the issues and frictions that would be involved in getting us from here to there and how they might be addressed. And they're all real, and I think the chairman understands that. But he also understands that the status quo is not working so well. And again, I want to thank him for taking time out of what I can promise is a very busy schedule. I told them this was an important audience because collectively the thought leaders on tax policy are in this room, and his job is to convince you that the House blueprint for tax reform will be good for the country. So please join me in welcoming Chairman Brady.
John, thank you very much for the introduction. Thank you for your leadership of this policy forum. It's rare, as you said, to be able to bring thought leaders together at such a critical time in tax reform. And as you know, we have spent a considerable amount of time together as we've worked on how do we leapfrog our America and our tax code back into the lead pack as the most pro-growth tax codes on the planet. And it requires us to be bold at every step in order to do that. So before I get wound up, thank you, John, for having me here today. Thank you for the host, Georgetown Law's Institute of International Law, and of course, the International Tax Policy Forum. And what you've done with this conference is just so impressive because of the bright minds that are in this room. And I think really it speaks directly to the outstanding work being done by today's sponsor organizations. More than that, I think it underscores the urgent need for leaders in Washington to take a hard look at where we stand globally and examine what we need to do to strengthen our international competitiveness. And I'd be remiss in not saying, while we're on the subject of bright minds, one of our bright minds on the Ways and Means Committee, Allison Hallatai, our general counsel and parliamentarian, is a graduate of Georgetown Law. So we're glad. Allison, where are you at today? Here's Allie. Thank you for being here. She's going to critique my speech, so, you know, get a little nervous about that. So, look, I jump at the chance anytime, anywhere to talk about tax policy. And today, though, is an especially historic day to have this discussion. Today's the 104th anniversary of the ratification of the 16th Amendment, which formally established the federal income tax. So, can I get a cheer for that? No, you don't cheer for that. Man, I asked the wrong question. So, the 16th Amendment is simple, and it's amazing. It's just 30 words. The Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. It's amazing to think what has come about from those simple 30 words. From those words, we now have the highest corporate income tax rate in the developed world. From those 30 words, we now have a tax system that puts made-in-America products at a tax disadvantage both here in the United States and around the world. We have a tax code that favors foreign products over U.S. products and chases American jobs in manufacturing and research overseas. And from these 30 words, we now have a tax code that's so complicated that according to Tax Foundation, American businesses and families spend more than a combined 6 billion hours and $30 billion just to file their taxes each year. And from those 30 words, we can all understand what Will Rogers meant when he said the difference between death and taxes is death doesn't get worse every time Congress meets. So here's what I think when I read the 16th Amendment. Our tax system doesn't have to be this way. We do not have to settle for what we have today. Congress shall have the power to lay and collect taxes on incomes from whatever source derived. That means Congress and the American people have a choice in how our tax system works. We have control over it. And if we don't like our current tax system, those 30 words give us the power to change it and put in place a new one that strengthens America in opportunity and wages. Whatever we want it to do, we can make it simple or as complex as we want. We can make it as pro-growth or slow growth as we want. We can make it as globally competitive or uncompetitive as we want. And so when House Republicans began developing the blueprint last year, those three choices were at the heart of every decision that we made. We looked at the boldest, most innovative policy solutions available, and just as all you have today, we took a hard look at where America stands today relative to our international competition. One thing became clear: not only are we struggling to compete and win internationally, many policy areas, we're not even in the game. Our local businesses are fighting with one hand tied behind their back, and there is no reason to stand idly by and continue to allow the status quo to continue. So with our blueprint, we said, let's make the system simple. Let's make it pro-growth. Let's actually build a tax code not designed to wring money from you, but designed and built for growth, the growth of jobs, the growth of wages, the growth of the U.S. economy. And thanks to the hard work of the members of the House Republican Conference, the Ways and Means Committee, we have 24 of the brightest tax minds in the House, and the leadership of our Speaker, Paul Ryan. We were able to pull this together and deliver, I think, propose the type of tax code our nation truly deserves today. Our blueprint delivers a tax code built specifically to leapfrog America from dead last among our global competitors back into the lead pack of the most pro-growth tax systems on earth. And we do that because we know what our competitors do. Just as every successful business, we know what our competitors do. So we start with providing the lowest tax rates in modern history for American businesses of all sizes. No longer will we be sitting on the sidelines with the highest corporate tax rate in the world. Instead, we're proposing a corporate rate of 20%, a rate that gets us in the game in a major way. For small businesses, for those who are not C corporations, no longer will you be taxed under the individual side of the code, that can at times can be as high as 44.6%. Instead, our Main Street job creators will be taxed at a top rate of no more than 25%. So they can keep more of what they earn, not sending it to Washington, but reinvesting it in their business, in their jobs, in their future. This reduction in rates for pass-throughs is truly historic. Exercising the choice and the power the Constitution gives us, we decided that for the first time in history, we would finally separate wage income from small business income. We decided that it was finally time to stop taxing Tom's bike shop like we tax Tom Brady. That is not a prediction on this weekend in any way in the Super Bowl. I'm a big fan of his. But for decades now, we've not been able to separate the small business person from the high wage earner. As a result, Tom's bike shop paid more. We're determined to change that. And while lower rates will certainly get us back into the game, it's not enough. For us to stimulate growth, for us to leapfrog our way back into that lead pack, we have to do more. So that's why we also take historic steps to unleash investment in America. So for the first time in history, our blueprint provides all businesses with the ability to immediately write off the cost of new capital investment, unlimited. So instead of the complex depreciation rules we have today, there will be a tax-free return on purchases of new equipment, technology, or machinery that our job creators need to produce and compete at a higher level. And this policy, which is full and immediate expensing, is one of the most pro-growth solutions we have in the blueprint. Not only will it unleash business investment, and here's the key, it's not about buying just equipment or technologies or computers or building, it is about productivity and the investment it takes, because that drives wages, that drives growth in America. And that, by the way, that business investment and the productivity that goes with it is what's been missing from this recovery for the past 8 years. And finally, to ensure we leapfrog America back into that lead pack and keep us there, we're proposing to replace our worldwide tax system with the territorial tax approach and to end the Made in America tax on U.S. exports. So unlike our foreign competitors, almost all of our foreign competitors, the United States doesn't currently tax the sale of products based on where the sale takes place. Instead, we tax the sale of products based on whether those products are made in America or if the business making them is headquartered here, hence the Made in America tax. And this tax is one of the most antiquated, uncompetitive, anti-growth features of today's U.S. tax code. It puts our Made in America goods, services, and intellectual property at a direct tax advantage here at home and the same abroad. And worst of all, in my view, it provides a direct tax incentive for businesses to move their jobs, their investment, their research, and their headquarters outside the United States. And today, for too many businesses, the best place to access the U.S. market is from outside the U.S. market. And that can't continue. So for the first time in our nation's history, we're proposing to end this Made in America tax and completely rework the way we tax the sales of foreign imports and American-made exports. Our proposal is simple, and it's based on one powerful idea. All products consumed in America will be taxed at an equal rate, a low business tax rate of 20%. And this policy, sometimes referred and now becoming much more known to the mainstream as border adjustability, is how all our foreign competitors implement their VAT taxes. But unlike our foreign competitors, this is not a VAT. And unlike our current tax system, it's not an origin-based business income tax. As I explain in our town halls back home, and I do more than 50 a year, and most of them on tax reform these days, imagine the current tax code is a spotlight that covers the whole stage. But imagine when a spotlight narrows down to just one character on that stage. That's what we're proposing in our tax code. Take this complicated, bloated, uncompetitive international code and narrow it down to spotlight to the United States and ask that basic, powerful question. Is your product, your service, your intellectual property consumed in the U.S.? If so, it will be taxed at a simple, low business rate. This is a smarter, a simpler destination-based cash flow tax that, as Alan Auerbach has designed and discussed and advanced throughout the years, is far more pro-growth for America. And with it, we will level the playing field finally. So no longer will foreign imports have an advantage over made in America products here in the United States. Instead, all products will be taxed equally. I can't think of anything fair than equal taxation. And additionally, no longer will made in America tax on U.S. exports or sales put our businesses and workers and products at a disadvantage overseas. So if your American-made product or service is sold abroad, it will no longer bear the U.S. tax, period. And in the end, this move to eliminate the Made in America tax is a simple but very powerful way to promote true competition based on price, quality, and service instead of tax regimes. And when combined with the other historic reforms of lower rates and full and immediate expensing, as well as territorial, it eliminates, and this is our goal, to eliminate every tax incentive to move your job and research overseas. In fact, to do the opposite, but to make America, again, a magnet for new business investment and growth in the 21st century. It is a game changer. And as simple as this solution is, taxing all products equally here in the United States, we also recognize that there will be questions and concerns. This is a major change from how we tax today. And while border adjustability may be well known among you and around the world, it is new to the United States. So we're listening carefully to those who are impacted. We're spending time discussing this with those who have questions. We welcome and expect that feedback. We work to improve this blueprint at every step in the process. So if there's anything you remember from today, it's this. If we have the power to make our tax system as bold, as pro-growth, and as competitive as we want, and we do, why in the world would we hang on to provisions that put our producers at a worldwide disadvantage and drive American business and jobs overseas? This is the one thing we can't afford to do. And today, we are closer to pro-growth, comprehensive tax reform than at any time in 30 years. And this moment may not come again. It may not come again. And as we move forward, I welcome your input, your feedback. We are open to the ideas that help drive America, again, into the lead pack for tax codes, that grow our economy and wages in a serious way, and that we continue to stay competitive in the future. So thank you again for having me. John, I'd be happy to take any questions the audience may have. You want to do that?
My question for the chairman. Well, I'll start out with one while people are generally not a very reticent crowd. Have you thought about how other countries?
Have you thought about how other countries in the world might react to this, and whether it's consistent with obligations we have with the WTO or other trade organizations? And
yes, we've certainly given a great deal of thought to that. I think talk of a trade war is silly. Frankly, what will they complain about? Stop copying us? Stop border adjusting your taxes as we do? We chose not to use a value-added tax for a number of reasons and go to this simpler cash flow system based on consumption in the United States. We think it's far more pro-growth, simpler to comply with, but it is economically equivalent to the value-added tax and the approach they use. I've been involved in 12 to 14 free trade agreements America has in place, and I'm confident that we will meet any challenge at the WTO because we're no longer merely adjusting an income tax. We are transforming ourselves to this cash flow tax based on consumption here, and we believe it meets the standards and the critique of the WTO. So, and also, too, I didn't see Kevin Hassett here earlier. Kevin, I want to thank you, as I did Alan, in bringing many of these bold, innovative ideas to our attention and continuing throughout the years to work with us to mold them. So thank you.
I have a question. I wanted to ask you about the lower rate you were proposing for small business pass-throughs income. And what was the thought there, that large pass-through businesses would be taxed still at the higher individual rate, or that they would be taxed as corporations?
Yeah, no, all non-C corps will be taxed at that lower rate. And this challenge came about simply because, as you know, the two biggest changes since Reagan reforms occurred. One, fewer and fewer Americans are paying more and more of the taxes. We know that on the individual level. But on the business side, fewer and fewer companies are organized as traditional C corporations. And so we wanted to make sure from a pro-growth standpoint that we were becoming competitive, not just on a part of the ledger, but the entire job creation network in the United States. So what we knew from the past efforts and to acknowledge the contributions, the work that Dave Camp did as chairman here, the work that my predecessor Paul Ryan did as well, informed us throughout this, and what we had learned, that keeping it just tied to the individual rate makes it incredibly difficult and expensive to lower those rates enough to be competitive. And so that's why we took the approach of splitting out wage income from business income. We hope to do that in a simple way as possible with clarity going forward. But this discussion in that regard has actually helped as we've looked at other parts of the tax code.
Chairman Brady, thank you for being here, and thank you for the speech as well. I'm curious, you've had some issues with retailers and refiners, and I'm just kind of curious as to how you would address the issue with retailers and refiners.
Sure. Look, imports are equally important to our economy as exports, but no one deserves special or favored treatment in our tax code, especially compared to our competitors worldwide. First, I don't think anything works as well for consumers as true competition. That's how you get better quality and better prices and better service. Secondly, I'm convinced that as we move this direction, as has happened in the past, that currencies don't freeze. You know, the economy doesn't stop. That as we strengthen the U.S. economy, as we strengthen our exports, the dollar will strengthen. The result of that, ultimately, that imports, frankly, more of them are purchased with that dollar coming in. The trade balances will reestablish. But this isn't just an issue of trade flows. This is about job and investment flows. And there's no question what we are doing here with this redesign is to drive job and investment flows themselves into the United States. And so I'm confident that, one, because of the economy's competition, what we know how currencies adjust, and because we are listening carefully and exploring a number of ideas on both the design and the transition of this provision to accommodate some of the concerns, valid concerns. I'm convinced that we can accommodate those who are a bit of hysteria, not so much. But at the end of the day, our tax code is not going to favor U.S. or foreign products over ours. They'll be taxed equally. And by doing that, by bringing the spotlight down to the U.S. and consumption, we are going to eliminate every tax incentive to move those jobs and research and manufacturing overseas.
Mr. Chairman, if the value of the dollar doesn't go up by 25%, there's some concern that products are going to cost more money for consumers. TVs, clothes, for example. Yeah. Can you guarantee that that will not happen? And if it does happen, should consumers be ready for that?
Yeah, so, you know, an obvious question is what happens to the 43% cut in business rates under that scenario, which obviously should be factored into that. Secondly, I am confident that our currency markets worldwide don't stop that day. You know, that they continue to adjust with stronger exports and a stronger economy. And I'm confident as well, sort of as the safety net under that, that the design of the border adjustability and the transition of it can allay those concerns. And I'll still say at the end of the day, the surest path to lower prices and better quality and service is through competition. And that's what occurs in this.
Mr. Chairman, have you given consideration at all to, rather than a wholesale replacement of the corporate tax day one, to have some sort of, say, predictable phase-in or phase replacement of the corporate tax?
So those are part of the discussion. The answer is yes. That's part of the transition process, and we have actively engaged leaders in the refining, the import refining, the export refiners and others. The domestic producers are very excited about this blueprint. So yeah, we have asked leaders to engage with us on the design and the transition and phase in of all of this. My view is their concerns about consumer impacts or tax impacts, we don't want those either. And so the design of this blueprint is to accelerate the growth, to address the transition of where we want to go. But at the end of the day, know exactly what we have to do, become competitive globally, means we cannot stay with the status quo we have today. Everyone needs to understand that. We are not going to continue a tax code that favors foreign products over U.S. products or keeps in place incentives for companies in research and manufacturing to leave the U.S. At the end of the day, that's not going to happen.
Mr. Chairman, are your counterparts in the Senate on the same page with you? Are you working together on this, or do you foresee, some challenges of reconciling different views?
It seems unusual that the Senate and the House might be on a different page. Here's the great news. I watched the work that Chairman Hatch and the Finance Committee has done, an awful lot of work over a number of years in areas on taxation to become competitive. I think that's incredibly helpful. Secondly, the Senate needs to develop their ideas on tax reform. And in the House blueprint, not only did we include the ideas of more than 50 lawmakers and a number of the best ideas from tax leaders in our country, but we included the solutions of nearly 23 to be exact, U.S. senators. My view is not only do we share the goals of simplicity and fairness and competitiveness, we actually share the solutions for those as well. So we start, I think, from a very good place. Because we're going very bold to leapfrog, we expect the kind of questions we're getting from lawmakers, from policy leaders, from the business community as well. So I think all this is very healthy. And at the end of the day, I think having this discussion now, early and intense, helps us meet our deadline of doing this in 2017. If I were smart, I would filibuster all these questions, and just keep going on and on. But we want to get as many as we can.
Hi, Chairman. Brian Chung, S&P Global. So I had a question about, in the similar vein, what I guess the alignment was with the White House on this particular topic. There was some talk that the president may not have been on board with the border adjustment tax, may have actually been supporting a tariff of some sort with certain countries. Can you elaborate a little bit more about how your committee is chatting and being on the same page with the White House?
So we started in a very good place in the sense that President Trump's tax reform plan was probably 80%, I think, was the common figure between that and the Republican plan. That's an excellent place to start from. So we've had a lot of good discussions with both Vice President Pence, and the Trump team on every provision in the blueprint. I see the common ground growing more and more each day. I think publicly it is easy, perhaps, to look at tax and trade issues as the same, but in truth, in this case, from a tax standpoint, we're talking about making the changes that allow us not just to meet what our competitors are how they're treating us, but to go beyond that. And I think tax done right can also lay the groundwork for trade agreements done right as well. And so my short answer is these discussions are exactly where I hope they would be at this point and going in the right direction. We're giving you a workout today with the microphone.
So, first, on behalf of Georgetown, Mr. Chairman, let me thank you very much for being here. And let me commend you for taking such a bold step towards tax reform in the United States. You had mentioned that you're considering various alternatives in transition. And one issue that addresses is the concern that some importers have raised about the potential impacts on costs of imported goods. Another issue that's implicated by the transition rules is something that's raised by a very different constituency, one that doesn't worry about prices for people living in small towns in America, or but asset values from the perspective of the Wall Street. Yeah, no. This is sort of the Wall Street asset value perspective, and I wonder whether you think that transition relief can also sort of address concerns about changes in the value of dollar-denominated contracts and stuff like that.
Yeah, so we are. Thank you. That is a great question. So as we've engaged the import community, recognizing that the export community and the domestic producers and all play also a big role in the economy. So we've asked them key questions. Tell us about your business model, your global supply chain, the length of those contracts and the denominations of them. Give us, to the degree you're comfortable, the model that you're using. Because as I've assured them, look, these are bold changes. We don't expect industries to change on a dime. A lot has been put into the business models. So we know where we are going and going to end up, and we're listening carefully to the transition to get there. Because again, I'm the more I learn about these models, these contracts, the supply chains, all this, the more confident I am that we can design this provision and the transition to be extremely pro-growth to the country, whether you are an exporter, an importer, or just a domestic producer. Thank you. Final thought. Thank you very much. No, stay, John. Look, this is a once-in-a-generation opportunity. This won't come back again. The elements that propelled President Reagan's reform have recreated themselves. We have a public that has had it up to here. The code is too complex. It's unfair. It's costly. It's special breaks for a lot of people and headaches for average people. They're fed up, just as they were before President Reagan led this effort. The second element is that there are bold, terrific tax reform ideas. Back then it was Jack Kemp and Bill Bradley. Today we have fair tax, flat tax, ABC tax, the work that's been done by Alan on the cash flow consumption tax, Kevin and others, and many lawmakers. That's recreated themselves. And now the third element has emerged, which is a president willing to lead on tax reform and expend political capital to make it done. That's why I know this is difficult. But this is our once-in-a-generation opportunity to do this, and I'm absolutely convinced, with a lot of hard work, focused this year, we can get this done. And we'd love to have your input as we do it. Thank you very much.
I just wanted to, again, thank the chairman for taking time from what is an incredibly busy schedule on a Friday, but much more importantly, thank him for his leadership on maybe the most important transformational change in the history of our country on our business tax system. And he and the speaker are really leading the charge. So thank you.